Hello, investors, and welcome to another S&P Stocks video. Now, today we're going to have something a little bit longer than our weekly 1-minute analysis. This video is dedicated to one of our indices, the S&PS Deep play. For those who don't know, the S&P Stocks Analysts Team has created a series of indices composed by different weightages of stocks from a certain sector or aimed at certain profiles of investors. The main goal of such indices is to overperform the overall market and/or the overall sector performance. For a better understanding of this mechanism, let's take a quick look at how the S&PS Deep Play Index works. As you can see, it all starts by choosing a certain sector and which companies will comprise the index. In this case, any company that has business related to the gaming industry can be part of the index. For example, Nintendo is a famous console manufacturer and also a game developer, so its performance will be highly affected by the gaming sector performance. Microsoft, in turn, is the manufacturer of the powerful Xbox. However, the performance of the gaming sector will have a lower impact on its shares price because Microsoft has a far wider playing field. Another example of a company that may be selected for this index is the video boards manufacturer NVIDIA. Game demand for high-performance video boards can considerably push the stock either up or down. So, the idea behind the S&PS indices is to help the investors to overperform a certain sector that he believes is a good one to invest in at a given moment. That is, if the sector seems promising, the S&P Stocks team will try to optimize the profits by choosing the best companies and permanently monitor the performance of each one. This also means that the index will have some changes from time to time. That said, let's get back to our Deep Play Index and see the companies that are currently part of it and how they got there. So, today, the index has 10 companies, where Japan's Nintendo is leading the weightage with 17.8% of the index total. In addition to all the fundamental and technical analysis carefully carried out by the S&P Stocks team, other important things are taken into consideration for choosing the companies to compose any S&PS index, such as 1. The potential impact of the sector's performance on the price of the stock. 2. The risk of the company, which is assessed through the S&P Stocks internal criteria and aims to give us an idea about the potential volatility that might affect the price of the stock. And 3. The risk of the country where the company is headquartered, which, in short, is assessed by a deep analysis of its current political and macroeconomy scenario. Okay, so now that we have all the companies, all the criteria, all the everything, you may be asking, all right, and how is the index performing? Well, last year was not good for the stock market overall, and the technology sector, which comprises the gaming sector, had a terrible performance. If the S&PS Deep Play Index had the 10 companies with the same weightage and equal 10% for each one, the performance would be like this. Negative 24.78% after 6 months. A small gain on the next 6 months, going to negative 23.35%. And some better recovery on the last month, completing 13 months with negative 18.63% in accumulated losses. However, we must consider 3 things here. The first one is that considering the different weightages, the actual one-year performance of the index was quite better. It's also better if compared to the NASDAQ 100, Dow 30, and the S&P 500. Let's take a look. We would have had a quite less bad start with a negative 15.75% on the first 6 months, negative 14.93% in 12 months, ending up the 13th month with negative 11.29% in accumulated losses. Quite better than if the investments were equally made on the 10 companies of the index. And the index proofs are also quite better than the average of the NASDAQ, Dow Jones, and Standard & Poor's indices combined. More precisely, a 10.78% better performance. That is, the arrangement of the S&PS Deep Play would have overperformed the overall market quite well, which is one of its main goals. The second thing to be considered is that the index has suffered some changes along the year. So, if we only consider its current arrangement, we won't have accurate past results. But honestly, such changes were not enough to prevent the losses on the last year due to the poor market overall performance. If you'd like to follow the changes made by the S&P Stocks team in real time, please join us at our website, www.spstocks.com. The third and final matter to be considered is that past results don't guarantee future performance. So if the index past results were good or bad, it doesn't mean at all that future results will be the same nor the opposite. This will always depend on several different factors. In conclusion, to sum up this video, regarding the future of S&PS's deep plays, we believe that the current arrangement of stocks is more likely to have a better performance when compared to each individual company if they were split in equal percentages. In addition, considering that the major idea of any S&P Stocks Index is to overperform the market itself, we also believe that the current arrangement has a good chance to keep overperforming the market. However, we remember that the index will probably have some adjustments in the future. Therefore, it's very important to follow them very closely on our website. So, in our opinion, this S&PS Deep Play Index might be a very good choice, especially for those investors who believe that the gaming industry has some good potentials. If you want more detailed information about this and other exclusive S&P stocks indices, such as the energy sector, the Big 9 techs, Buffett's 11, and many more, you're more than welcome to join us at our website, www.spstocks.com.